Let me tell you about Alex, a bright, ambitious young man, eager to make his mark on the world. He was always looking for opportunities, a way to get ahead, a shortcut to success. A guy who thought he'd found the next big thing in the stock market. He believed he had discovered a hidden gem, a company poised for explosive growth. He was convinced this was his ticket to financial freedom. He'd saved up a few $1,000s, carefully putting aside money from each paycheck, dreaming of a better future. Convinced he could strike it rich with one perfect pick. He envisioned himself as a savvy investor, outsmarting the market and reaping the rewards. After weeks of research, poring over financial statements, reading analyst reports, and watching countless hours of market news, he put every dollar into a hyped-up tech stock. He went all in, betting the farm on this one company. At first the price climbed, the stock soared, validating his decision and fueling his confidence. Alex felt unstoppable. He was on top of the world, a financial genius in his own mind. He started dreaming big, picturing a life of luxury and freedom, paying off loans, freeing himself from debt, buying a house, a place to call his own, maybe even quitting his job. The thought of escaping the daily grind was incredibly appealing, but then, bad news hit, a sudden and unexpected turn of events. A product delay, a regulatory setback. The company's prospects suddenly looked much less promising. The stock tanked, the price plummeted, erasing his gains in a matter of days. Alex watched his savings vanish. He felt a knot in his stomach as he saw his dreams slipping away. He held on, hoping for a miracle rebound. He refused to sell, convinced that the stock would bounce back. It never came. The stock continued its downward spiral, defying his hopes and expectations. In the end, his account was nearly wiped out. He had lost almost everything he had invested. The real pain wasn't just the money, it was the emotional toll of the experience. It was realizing he'd gambled, not traded. He had treated the stock market like a casino, relying on luck rather than skill and strategy. He'd bet everything on one outcome with no backup plan. He had put all his eggs in one basket, a recipe for disaster. That's when Alex learned the most important lesson, a hard-earned lesson that would shape his future investment decisions. It wasn't about picking the wrong stock. It wasn't just bad luck or a poor investment choice. It was about having zero risk management. He had failed to protect his capital and manage his risk effectively. Trading without a safety net is just gambling. It's a reckless and dangerous approach that can lead to devastating losses. Alex's story is a warning, a cautionary tale about the importance of responsible investing. Don't risk it all on a single bet. Diversify your investments and spread your risk across multiple assets. The market rewards discipline, not desperation. Patience, research, and a well-thought-out strategy are essential for long-term success. Learn from Alex. Protect your capital first. Always prioritize risk management, and never invest more than you can afford to lose. Risk management isn't just for Wall Street pros, it's the foundation of every successful trader. It's not about avoiding risk, but controlling it. Think of it as your defense, rules you set before you trade, designed to protect your money from disaster. The key is deciding in advance how much you're willing to lose on any trade. Professionals survive losses because they have a plan. Amateurs get wiped out hoping for luck. Risk management is your business plan for trading. Without it, you're just gambling. Let's get practical and dive into some actionable strategies. We're going to explore two simple yet powerful tricks that can significantly enhance your ability to protect your trading capital. These aren't just abstract concepts, they're concrete rules you can implement immediately. The first rule, and perhaps the most crucial, is this. Never risk more than 1% of your trading capital on a single trade. This is your primary defense against catastrophic losses. This 1% rule applies to your entire trading capital on a single trade. It's a non-negotiable limit that safeguards your funds. So, let's illustrate this with an example. If you have $5,000 available for trading, that translates to just $50 of potential risk per trade. That's your absolute maximum. It might sound small, almost insignificant, but adhering to this rule makes blowing up your entire account nearly impossible. It provides a crucial buffer against a series of unfortunate trades. This rule also keeps your emotions in check, no panic-induced decisions, no reckless attempts to recoup losses. It promotes a calmer, more rational approach to trading. The second rule, equally important, is position sizing. This is how you determine the appropriate number of shares to buy for each trade. Don't make the common mistake of simply buying the same number of shares every single time regardless of the stock's price or your risk tolerance. Instead, carefully calculate how many shares to buy for each individual trade. This calculation should be based on your predetermined risk per trade, which we've established as 1%, and the placement of your stop-loss order. Let's revisit our example. A $5,000 account with a $50 risk limit per trade. Now imagine you're trading a stock priced at $25, and you've set your stop-loss order at $24. This means your potential risk per share is $1, the difference between your entry price and your stop-loss price. Therefore, to stay within your $50 risk limit, you would buy 50 shares of that particular stock. If the trade unfortunately goes against you and hits your stop-loss, you lose exactly $50, your pre-planned and acceptable risk. These two rules, simple as they may seem, consistently risking only 1% of your capital and diligently sizing your positions based on your stop-loss, are your protective shield in the volatile world of trading. They allow you to stay in the game for the long haul, enabling you to learn and adapt with each trade. Sadly, most beginner traders completely ignore these fundamental principles and ultimately pay a very steep price for their negligence. Don't make the same mistake. Don't be one of them. Prioritize protecting your trading capital first and foremost. Consistent profits will naturally follow as you refine your skills and strategy. The stop-loss order is your automatic safety net, a crucial tool in managing risk. Think of it as an insurance policy for your investments. It's a preset order to sell, automatically triggered when a specific price threshold is reached. If a stock drops to a certain price, this predetermined level acts as a safety valve, preventing potentially larger losses. Decide your exit before you enter the trade. It's a cornerstone of sound risk management. When you're calm, not emotional. This proactive approach ensures rational decision-making, free from the influence of fear or greed. A stop-loss removes hope and hesitation. It eliminates the temptation to hold on to a losing position, hoping for a turnaround. It enforces discipline. It forces you to stick to your trading plan, regardless of market fluctuations. Using our earlier example, let's illustrate how a stop-loss works in practice. Buy 50 shares at $25, initiating your position in the market. Set a stop-loss at $24. This means you're willing to risk $1 per share on this trade. If the price drops, contrary to your expectations, your broker sells automatically, executing your stop-loss order without delay, capping your loss at $50. This is calculated as $1 loss per share multiplied by the 50 shares you own. You don't have to watch the screen constantly, glued to every tick of the price, or second-guess yourself, questioning your initial analysis. Yes, sometimes you'll get stopped out by a quick dip, a temporary fluctuation in the market, but that's a small price for protection against potentially devastating losses. Never trade without a stop-loss. It's a fundamental rule of responsible trading. It's the single best tool to preserve your capital, ensuring you can continue trading another day. Professionals use it every time. They understand the importance of protecting their investments. So should you. Embrace the stop-loss order and trade with confidence. Beyond rules and stop-losses, build habits that keep you disciplined. Keep a trading journal. Log every trade, your reasons, your emotions, and the outcome. Over time, you'll spot patterns and mistakes you can fix. Next, focus on risk-to-reward ratio. Only take trades where your potential reward is at least twice your risk. If you risk $50, aim to make $100. Even if you're right only half the time, you'll come out ahead. 10 trades, win 5, lose 5. You make $500, lose $250, you're still up. The math works if you stick to your plan. You don't need to win every trade, you just need your winners to be bigger than your losers. That's how you build a sustainable trading career. The real secret? Trading is a marathon, not a sprint. Forget the overnight millionaire stories, they're rare exceptions. Your capital is your inventory, risk management is your insurance. Protecting your money is your top priority. Every rule you follow is designed to keep you in business. Don't chase quick wins, focus on flawless execution and discipline. Celebrate small, controlled losses, they mean your system works. Most traders fail because they ignore risk. Survive your first year and you've already won. Master risk management and you'll have a real shot at lasting success.